Okay, let's dive right into this. Welcome to today's Explainer, where we're going to unlock one of the absolute most vital inventory valuation methods in all of accounting. It's called FIFO, or first in, first out. Now, whether you're a business owner, an accounting student, or just someone kind of fascinated by how commerce actually works behind the scenes, mastering how we value inventory is absolutely crucial. Why? Well, because the method a business chooses directly impacts their cost of goods sold, their gross profit, and the value of that closing stock sitting right there in their warehouse. So today, we're going to make calculating FIFO incredibly easy and honestly pretty intuitive.
Here is our roadmap for today. First, we'll pin down exactly what FIFO is. Second, we'll do a step-by-step calculation. Third, we'll calculate closing inventory. Fourth, we'll weigh the pros and cons. And finally, we'll look at some real-world examples. All right, Section 1. What is FIFO exactly? First in, first out.
So, FIFO stands for first in, first out. But I really want you to pay close attention to this definition. It's an accounting assumption where the goods purchased first are assumed to be sold first. I can't emphasize the word assumption enough here. This doesn't necessarily mean that the oldest physical boxes are literally the ones being loaded into a delivery truck and leaving the warehouse first. Honestly, the physical movement of goods might be completely random. FIFO is simply the way we track the costs of those goods on our financial statements. We just assume, for accounting purposes, that the earliest costs we brought into the business are the first costs we send out the door when a sale is actually made. Let's move right along to Section 2 and see how this builds with a step-by-step FIFO calculation. Imagine you're standing in a warehouse looking at the inventory logs. We've got 3 distinct batches of inventory sitting there, acquired at different times and, crucially, at different prices. First, we have our opening stock, 100 units that cost us 50 rupees each. Later on, we made purchase 1, 150 units, but the price went up to 60 rupees each. And finally, we made purchase 2, 200 units, and the price bumped up again to 70 rupees each. So we've got a warehouse full of 450 total units at varying prices. Now, here's the scenario. A customer comes along and we make a massive total sale of 300 units. How in the world do we calculate the cost of goods sold for those 300 units? Well, we apply our FIFO rule. We start from the absolute oldest stock and just work our way forward until we hit our target of 300 units. Step 1, we take all 100 units from our oldest batch, that opening stock. 100 units times 50 rupees equals 5,000 rupees. But hey, we need 300 units, so we still need 200 more. Step 2, we move to the next oldest batch, purchase 1. We're going to take all 150 units from this batch. 150 units times 60 rupees gives us 9,000 rupees. Okay, so 100 plus 150, that's 250 units accounted for. We only need 50 more units to reach that 300-unit sale. Step 3, now we dip into our newest batch, purchase 2. We definitely don't take all of it, we just take the 50 units we need. 50 units times 70 rupees equals 3,500 rupees. And just like that, we've perfectly accounted for the 300 units sold by peeling back the layers of our inventory, literally from oldest to newest. And when we add up those 3 steps, 5,000 plus 9,000 plus 3,500, we get our final answer. Boom, 17,500 rupees. That right there is our total cost of goods sold, or COGS. It's just a beautiful, logical progression. By strictly following the first-in costs to figure out our first-out costs, we've successfully mapped out the exact expense tied to this specific sale.
All right, pivoting to Section 3, calculating closing inventory. What about the remaining stock? Now, you might be wondering, especially looking at that last step, wait a minute, why didn't we use all of that 70 rupee inventory from purchase 2? We had 200 units of it sitting right there. Why stop at 50? Well, remember our core rule. FIFO mathematically forces us to satisfy the sales volume using the oldest layers first. Because our sale was strictly 300 units, and those older layers already provided 250 of them, we only needed to dip into that final, most expensive layer for the remaining 50.
So, what exactly does that leave us with? Think about it. From that final batch of 200 units, we only skimmed off 50 for the sale. That means 150 units are still sitting comfortably in the warehouse. And because they were from that final purchase, they are naturally valued at that newest price point of 70 rupees. Multiply those remaining 150 units by the 70 rupee price tag, and you get 10,500 rupees. That is our closing stock value. And this brilliantly illustrates a really fundamental hallmark of the FIFO method. Under FIFO, your cost of goods sold is made up of your oldest prices, which means your closing stock is always made up of your absolute newest, most recent prices. Just look at how this math elegantly balances out. We started with 450 total units. We systematically carved out 300 of them, layer by layer, starting from the 50 rupee batch, to build our 17,500 rupee cost of goods sold. That left exactly 150 units from the final 70 rupee batch, giving us our 10,500 rupee closing stock. Every single box and every single rupee is perfectly accounted for without any guesswork. It's like a giant puzzle and all the pieces just fit.
Now, let's shift our brains from the math to the business theory for Section 4, the pros and cons of FIFO. Let's start with the advantages. FIFO is incredibly popular, and for good reason. First, as we literally just saw, it's super easy to understand and calculate. Second, it's widely accepted by major accounting standards like IFRS and IND AS, making it a really safe, compliant choice for international businesses. And third, because your closing stock is based on the most recent purchases, the inventory value on your balance sheet is a very accurate reflection of current market prices. But there is a disadvantage, a pretty significant one. It can heavily distort your profits and your taxes during times of inflation, when prices are rising.
Think about how this distortion happens using our earlier example. Prices were rising from 50 to 60 to 70. Classic inflation, right? Because FIFO forces you to match your oldest, cheapest costs against your current revenue, your cost of goods sold ends up being lower. Now, a lower cost artificially inflates your profit margins on paper. You look highly profitable. But here is the catch. Higher paper profits mean a higher income tax bill. So in an inflationary environment, FIFO can actually drain cash from a business because you're paying taxes on those inflated profits. It's this domino effect that business owners have to monitor very, very closely.
Grounding this in reality, let's hit Section 5, real-life examples of FIFO in practice. So earlier I mentioned that FIFO is an accounting assumption, but actually it's the absolute perfect system for businesses where the physical flow of goods does match the accounting flow. Think about perishable goods. If you run a supermarket, you purposefully stock the older milk packets at the front of the fridge so customers buy them first before they expire, right? The exact same thing goes for medicines, fresh food, or even electronics that become obsolete super fast. In these industries, you physically want the first in to be the first out, making FIFO the most logical and accurate reflection of how the business actually operates day to day.
So, as we wrap up this explainer, I really want you to burn this golden rule into your memory. This is your ultimate shortcut. First in, first out. The oldest cost is sold first, meaning it makes up your cost of goods sold. The newest cost is left behind, meaning it makes up your closing stock. If you can just remember this simple dynamic, you can tackle absolutely any FIFO scenario you encounter, no matter how crazy the warehouse logs get.
I'm going to leave you with this provocative thought to apply to your own business environment. Let's say inflation spiked tomorrow and your supply costs just skyrocketed overnight. How would your bottom line change if you were locked into the FIFO method? Would those older, cheaper costs artificially boost your profits? And more importantly, are you prepared for the tax bill that follows? Really think about how this accounting assumption physically impacts your real-world cash flow. Thank you so much for joining me for this explainer. Keep practicing these concepts, and I highly encourage you to look at your own inventory through the powerful lens of FIFO.